Ever wonder how some investors seem to always know where the market is heading next? It's not magic, it's data. Economic indicators like GDP, inflation, and unemployment give us a sneak peek into the future of the market. In today's video, I'm going to show you how to interpret these key economic signals and use them to predict market trends so you can make smarter, more informed investment decisions. Stick around and let's dive into it. Before we get into how to use them, let's quickly define what economic indicators are and why they matter. Simply put, these are data points that reflect the health of the economy. Things like gross domestic product, GDP, inflation rates, and unemployment numbers. When you understand these indicators, you are better equipped to predict market movements. Think of them as the heartbeat of the economy. When they shift, markets react. Let's break down the three big ones you need to watch. Let's start with GDP. This measures the total value of all goods and services produced in a country. When GDP is growing, it's a sign that the economy is expanding, which usually leads to rising stock prices. But if GDP is shrinking, that could signal a recession, meaning stock prices may fall. So, how can you use GDP to predict market trends? Watch for quarterly GDP reports. If they come in higher than expected, it's often a bullish sign. On the other hand, lower than expected GDP can be a red flag for potential downturns. Next up is inflation, which measures how much prices are rising. A little inflation is normal, but too much can cause problems. Why? Because when prices rise too fast, consumers and businesses may cut back on spending, which slows down the economy. Central banks, like the Federal Reserve, often raise interest rates to combat inflation, which can hurt stock prices. To predict market trends using inflation, keep an eye on inflation reports like the Consumer Price Index, CPI. If inflation is rising quickly, expect potential market volatility, as investors may sell off stocks in anticipation of higher interest rates. Finally, let's talk about unemployment. High unemployment usually means fewer people have money to spend, which can hurt company earnings and, in turn, stock prices. Low unemployment, on the other hand, typically indicates a healthy economy where businesses are growing and hiring more workers. But here's the twist: sometimes, really low unemployment can lead to inflation, which could cause central banks to raise rates and slow down the market. The key here is balance. If you notice unemployment starting to rise after a period of economic growth, it could be a sign that the market is heading for a slowdown. Now that you understand the big three indicators, how do you use them to actually predict market trends? Here's how to put it all together. One report won't tell you much, but consistent patterns will. For example, if GDP is growing quarter after quarter, inflation is stable, and unemployment is low, that's a strong signal of a bullish market ahead. On the flip side, if GDP growth slows, inflation spikes, and unemployment rises, we might be looking at a market downturn. Sometimes, these indicators don't move in sync. For example, GDP might be growing, but inflation is rising too quickly. This divergence can indicate that a correction is coming. Pay attention to how central banks react in these situations, as interest rate changes often follow. Speaking of central banks, they are the ones who react to these economic indicators. When inflation rises too fast or unemployment spikes, central banks like the Federal Reserve step in to adjust interest rates. And those rate hikes or cuts directly influence the stock market. By understanding how central banks are likely to respond to these economic indicators, you can better anticipate market trends. Now that you know how to read the signals, how can you use this knowledge to make smarter investments? Make it a habit to follow economic reports. You don't need to become an economist, but staying informed about the latest GDP, inflation, and unemployment numbers will give you an edge in the market. For example, if GDP is steadily rising and inflation is under control, it might be a good time to add to your portfolio. On the other hand, if unemployment is spiking and inflation is out of control, it might be a good time to reduce your exposure to stocks. Different sectors perform better during different stages of the economic cycle. For instance, tech stocks often do well in times of growth, while defensive sectors like utilities perform better during economic slowdowns. Use economic indicators to shift your portfolio accordingly. Economic indicators are the secret sauce behind smart investing. By tracking GDP, inflation, and unemployment, you can stay ahead of market trends and make more informed decisions. If you found this video helpful, don't forget to subscribe for more insights like these and hit the notification bell so you never miss a new video. Leave a comment below if you have questions or want me to cover a specific topic next time. Thanks for watching and happy investing.